In this presentation, we will use tax software to consider the itemized deductions and the Schedule A and the tax forms that will be generated with the tax software. We will be using Lacerte tax software. Lacerte is owned by Intuit, the owner of QuickBooks. Other tax software will be similar in that you'll have the data input section that will then help us to generate the actual forms, those being the 1040 and the Schedule A in this case. Here is our Form 1040. We have Tim Jones. We have the single individual. We're going to scroll down. That's going to be the filing status, no dependents. And then we have the wages. All we have are the W-2 wages, W-2 income at the 100,000. That 100,000 pulls down to line 7 where we have the 100,000 total income. Then we have the adjusted gross income of the 100,000. We have no above the line or Schedule 1 adjustments. Then we have the standard deduction or the itemized deduction. In this case, taking the standard deduction, that being the 12,200. Then we have the 100,000 minus the 12,200, providing us with that 87,800. That's going to be the taxable income that we would then be applying the tax on. We're concentrating on this number, which is currently at the standard deduction rather than the itemized deduction. Now, if you were to put this into an Excel worksheet just with our formula, we'd have a similar kind of setup. We'd have the gross income supported by the supporting schedules, the above the line or Schedule 1 deductions, the adjusted gross income, and then the standard deduction we can get just by the filing status. So we have the filing status single here. There's going to be our standard deduction. If we take the 100,000 minus the 12,200, we get the 87,800. Now, what we're going to consider here is what happens when there's going to be some type of itemized deductions, that being on the Schedule A. You'll note on the left, the Schedule A, when I show only the necessary returns or the necessary forms are not over here. It's not something that's being included. What if I go into the Schedule A and I say, let's go into the data input for Schedule A, itemized deductions, and let's go down to the contributions and just say there's a big contribution. Let's keep the contributions. They're going to push us over. And I'm going to go back over to the forms. Now we're at the 17,010. So this number here, of course, changed, line 9. I would expect it to be 12,200 based on the filing status if we were to be using the standard deduction, but we are not. We're now itemizing, and therefore we see this populated Schedule A on the left, which is now a necessary form that we would need to include with the tax return. Going to the Schedule A then, we see our categories. We've got and if we just list out the categories, we've got the medical and dental, the taxes you paid, the interest you paid, the gifts to charity, the casualty and theft losses, other itemized deductions, and the total itemized deductions. So first thing we want to note is that these itemized deductions are severely limited. Notice if I'm an individual taxpayer, the itemized deductions then would have to basically be above the 12,200 in order for it to be worth it for me to add up the itemized deductions. And then we need to get into the restrictions about what itemized deductions, what types of restrictions are within these, what can be included in itemized deductions, and what type of income limitations are there on there. Now, we just included, for example purposes, the 16,000. So here's the 16,000. That brings the itemized deductions to the 17,010 because we're also including the taxes you paid, which the software is calculating for us. We'll talk more about that in a future presentation. And that's going to give us the total 17,010, which of course you saw pull over to line 1 of the 1040. Now, if you're entering this into something like Excel then, in our little worksheet to support this, to back this up, we're then going to go to the Schedule A. And I'm going to say, all right, gifts. We had the gifts is going to be, I said 16,000. And typically we may have to depend on the software to some degree to calculate the taxes. And we'll talk more about that later. So the taxes, I'm going to say are 1,010. So I'm going to go back over to our software and we're going to say this is 1,010. There's our total. That adds up then to the total of the 1710, which pulls over to the tax on page 1. So I'm no longer taking the standard deduction. I'm just going to delete it. We're going to be taking the itemized deductions. And that's how I would basically think about it in terms of the tax software. That way you have to manually make that change instead of the software kind of doing it for you, and it'll kind of hopefully register in your mind more as you do that double check. And so now we're taking the 100,000 minus the itemized deduction rather than the standard deduction to get us down to that 82,990. So that's 82,990. And if we go back to the page 1 of the 1040, we're down to the 82,990. Now, what would happen if I changed the filing status? You'll note that the filing status for married is all the way up to 24,400 because in essence it's twice the single status. So I'm currently at the standard deduction here at 17,010 rather than the 12,000. I'm currently at the itemized deduction at the 17,010 as opposed to the standard deduction for a single individual at 12,200. If I then make this return a married couple, it'll jump back, you would think, right, to the 24,400 because it would then be larger than the standard deduction at the 17,010. So if I go back over and I'm going to say, all right, let's go to the data input screen, and we're going to then say that they're not single anymore. This is a married filing joint. So married filing joint, we have everything we need there. Back to the forms. So we're back on the 1040. If I scroll down then to the standard deduction and itemized deduction, we're at the 24,400. We no longer see a Schedule A. It has disappeared because we're not taking the itemized deduction. So that means if you're talking married a couple, then you're talking 24,400 of itemized deductions before they might get a benefit from it. So that's pretty big hurdle to jump over. Now, what are the things that are typically going to push people over so that they are itemizing as opposed to taking the standard deduction? Well, if they own a home, they have the mortgage interest on the home. That could be a very large item, especially if they live in areas of the country that the homes are more expensive, right? If they live in a high cost of living area, then they could have a substantial amount of interest that are going to be on the home. Property taxes, therefore, if they have a home, they're paying property taxes most likely on that. That will be significant. So the ownership of a home and the loan related to the ownership of the home, specifically the interest being paid on the loan related to the ownership of the home, is going to be one of the big things that are going to push people over. Also, if you're living in a high tax area, so if you're living in like California or New York possibly, then you possibly are going to have higher state taxes that you'll be paying. That's another huge thing that will push people over. So usually who's going to be pushed over the standard deduction? Usually people that are living in places that it's a higher cost of living to live in that place, and people that typically own a home and therefore have a mortgage most likely on the home, paying interest on that, property taxes on that, and on top of paying taxes in a fairly high cost of living area for basically state taxes as well. For example, if I go over to our itemized deductions now and you're saying, all right, it may not be worth it if someone at this point to add up the itemized deductions, but if we go into the deductions area and we go to the itemized deductions and I go into the interest items and we say that we have the mortgage interest, and let's say that was, 24,000 or let's say 21,000. And then I go back over and go back to the forms. Now we're at the 38,098. Now notice again, if I go back over here and I delete, say, the cash contributions and of the 16, and I say that we have the mortgage interest then, let's say at 25,000, and I go back up to the forms. Now we're at 26,094. If I go to Schedule A, for the supporting documentation, that's because we have the state taxes being calculated by the software. I didn't put in property taxes here. Just an example to push us over. And there's the 25,000. But note at this point, if that was all that we had, just realize that although we're getting this huge $25,000 deduction for the mortgage interest, it's really more confusing than that. Because if you're thinking about purchasing a house and you're saying, well, if I purchase the house, I get to write off all the mortgage interest. It's not quite that simple because, the mortgage interest is going to push you over to the point where you're going to be taking that deduction. But if you're married filing joint, then you would have already got a 24,400 deduction. So you're only getting the benefit of the difference now, the 26,098 minus the 24,400. So the deduction related to the mortgage interest is a little bit confusing when you think about the home purchase and whether or not how beneficial it's going to be for the taxes. You got to take into consideration the benefit that you're getting above and beyond basically what would be the standard deduction. Also, of course, you're going to have a more complex return just in general. You're probably going to have to do more tax planning just in general on that. And so these are just some things to keep in mind. It is a huge deduction and can be a great thing because if I go back down to the Schedule A, once you're over that limit, then it really opens up the door to possibly take some more of these other deductions as well, because you wouldn't have been able to take these other deductions if you were under that limit. But I just point that out because when you talk to real estate brokers and stuff like that, they are probably going to be emphasizing the fact that you have a $25,000 deduction if you spend that money on the mortgage interest, but you're not really getting a $25,000 of benefit typically, because if you're not close to the standard deduction already, you're not getting all that benefit. So I just, you want to keep that in mind when you go in there. Anytime that you basically have to take on debt and pay interest in order to get a tax deduction, it's not quite that straightforward that you're going to come out on a win-win there, because, you're paying the interest dollar for dollar. The deduction's going to be not dollar for dollar, even if you got the entire deduction, and it's going to be limited with regards to the itemized deduction. So still a huge deduction, and it's something that you have to weigh in there and consider when considering the home purchase. But, you want to keep that in perspective as well, especially when you're talking to mortgage brokers and whatnot who obviously have an invested interest in making a home sale. Now, if we go back to the page 1, and you have a similar type of scenario if we were to go to single but head of household. So if I was to go to single head of household, back to the detail up top, we go to the client information. I'm going to say now they're head of household and say, okay. If I go back to the forms, then we now have the itemized deduction of the $26,010, which is clearly over the form for the head of household, which would be $18,350. So again, if I went back to the deductions and I said we had deductions down here in the itemized deductions, and we had a home, let's say we had a home, but we didn't take out a substantial amount of debt to pay for the home, which is typically you would think of as a good thing. But for deductions, the interest is the good thing, for deductions. But obviously, you'd rather not pay interest if you don't have to. But let's say we had the $15,000 for interest here, and that's all we had. And we go back over and say what's in the tax form now. It's going to be at the $18,350. Not taking the standard deduction, not taking the itemized deduction. So in that case, you had a home that was taken out paying $15,000 in mortgage interest. And again, it might be over if it was that much, because we'd have property taxes and possibly charity and other types of things. But so in any case, it's just something that you want to kind of consider. It's been one of those types of deductions that's kind of confusing. It really confuses one of the bigger purchases in most people's lives, which is the purchase of a home or not. And then the interest related to that and the deduction related to that can be kind of confusing. And so so when you do take the interest deduction and the property taxes into consideration, just remember to take into consideration the standard deduction, and also remember that the current changes in the standard deduction, the increases in the standard deduction, have an impact as to the deductibility or the amount of deductibility of the write-offs that you would have for mortgage interest and property taxes in many cases.